Good morning, everybody. It's Monday, June 10th, 5:26 a.m. Central Time. Grain markets are mixed this morning. July corn futures up 2.25 at 451. July soybeans up 2.5 at 1181 and 3/4. July Chicago wheat down 2 3/4 at 625 and a quarter last trade. July Kansas City wheat down 9.5 at 656 and a quarter. July spring wheat down 3 1/4 at 691 even last trade. Let's start off with the weather and this heat that's in the forecast.
So, a long stretch of above normal temperatures may impact the U.S. Corn Belt beginning early next week. The forecast indicates that a stretch of temperatures from 5 to 10 degrees above normal will begin on Sunday next week and last for at least 7 to 10 days. With regard to precipitation, most of the region will be dry through the 5-day period. Rain is slated to return to the western Corn Belt early next week. Many central and western areas will see accumulation during the 5 to 10 day period, while the east will remain drier.
Heat could become a concern here. The heat that's in the forecast doesn't begin until like Sunday or Monday next week. And looking at the GFS, the most recent stuff I saw this morning indicates that temperatures could run 5 to 10 degrees above normal for a stretch of at least 10 days. And once you get out past that 10-day period, things become kind of murky and unreliable. So the trade and forecasters also are probably not completely sure of this forecast by any stretch. But you look at the maps, I mean, 6 to 10 favors odds of above normal temps. 8 to 10, same thing. The 3 to 4 week temp outlook is a couple days old, but same thing. Maybe rain is the bigger concern, and there is rain expected to return. If they were to take this rain out of the forecast for that 5 to 10 day period and say we were hot and dry going into the third, fourth week of June, even into 4th of July, that would consider to be that would be a bullish factor when it comes to price action. But for right now, the market seems disinterested. But I wouldn't sleep on this heat thing. I would very much pay attention. If you were to run into a scenario where, say, you see your normalish rainfall through second half of June into July, but this heat actually does come to fruition and you see above normal temperatures, it's something that could come back to bite you in regard to yields later in the growing season. We've seen that in years over the past where, they figure out in September or October that, hey, these warmer temperatures and especially overnight warmer temperatures had an impact on the crop, and we just didn't see it during the growing season. We've seen that happen before. I'm just kind of thinking out loud here. I'm not trying to predict what's going to happen, but just paint a couple different scenarios. But keep this heat on your radar here.
Fund traders have increased their net short position in the corn market. CFTC released weekly commitment of traders data on Friday. During the week ending June 4th, the funds were net sellers of 88,000 contracts of corn. Funds were net sellers of 39,000 contracts of soybeans, and they were net sellers of 5,000 contracts of SRW wheat on the week.
Again, no love for the grain markets among large speculators. Across these three contracts, corn, soybeans, SRW wheat, funds sold 132,000 contracts during the week ending last Tuesday. So the net short across those three contracts is 297. It's still far removed from the peak. It was almost 530,000, I think, a couple months ago. So funds are not as short as they were, but still a very large net short position across the complex. And in order to see another short covering event, you're going to need a weather issue, I think.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell me about some of last week's videos?
Whole bunch of fun stuff last week. I did a grain marketing review, I believe, on Thursday. And in these grain marketing reviews, I run through everything that I've advised our subscribers to do when it comes to cash sales. We run spreadsheets that look like this. I break down everything I've advised. It's broken down by crop year, by percentage. I give you the dates that everything was advised, talk about kind of the game plan moving forward. If you guys are behind on your marketing, if maybe you just want an additional reference, I think this is worth the $50 per month for the premium stuff by itself. Jim was on Friday. We did Macro Friday, as we do every other Friday. Talked about election stuff, how some of it could maybe play into the markets a little bit. Talked about a lot of other stuff too. National spending and government spending and the national debt has been a very hot topic. Talk about interest rates, a lot of things along those lines. Pete Meyer was on yesterday. He did a pre-open weather update for us, as he will be doing through like the first half of July at least, depending on how the weather situation shapes up. So as we get more deep into these weather markets, this is something you're going to want to watch every Sunday night before the market's open. If you guys want to see the premium stuff, go to standardgrain.com this morning. Sign up this morning. I'll send you over a copy of this morning's email, which includes all those videos that I just mentioned and a whole bunch of other stuff, a lot of graphics and charts that we don't show here on YouTube. It's a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else, guys. As I mentioned before, we don't want to do your futures business. We don't want your consulting business. There's no other fee. Everybody pays the same $50 per month. This is the most transparent way that I can stay involved in the grain marketing business and kind of do it the way that I want, full transparency, all that stuff. So check that deal out this morning.
A change in Brazil's tax policy could make Brazilian soybeans less competitive. Last week, a temporary rule was passed that limits the availability of tax credits for Brazilian commodity exporters and processors. According to risk management firm Amius, traders will likely increase soybean prices to compensate for the rule. As a result, Brazilian soybeans will be less competitive with American beans, at least in the immediate future. The rule will go into effect immediately and will need congressional approval within 4 months to remain valid. If approved, the measure will discourage domestic consumption and could result in increased Brazilian soybean exports next season.
The U.S. market or U.S. futures rallied for like one day on this news. I believe it was Thursday last week, and everything is kind of set back since. The one guy from this firm wrote this. He said, in this scenario, there would be a shift in soybean demand to the U.S., removing Brazil as a competitive source between August and September, thus accelerating the U.S. export program. I don't know. I'll believe it when I see it. When we start to see a whole bunch of additional export sales to China or whoever else, then this will maybe means something. As I understand it now, U.S. beans are still really not competitive, but hope this guy's right.
Chinese imports of soybeans declined last month. During May, imports totaled 10.2 million metric tons, down 15% from May of last year. However, imports were the second highest on record for the month. Imports were expected to reach between 11 million metric tons and 12 million metric tons. During the first 5 months of this year, Chinese soybean imports totaled 37.4 million metric tons, down 5.4% from the same period last year. Floods in the southern part of Brazil have impacted soybean imports, and because of those floods, June imports are expected to be smaller, right around 11 million metric tons.
Here's a chart of U.S. soybean export sales, total commitments by country for this marketing year. So this is the marketing year that ends at the end of August. And China accounts for 55% of all total commitments, and exports are projected to account for 41% of all demand for U.S. soybeans. So China is more than 20% of your demand base for soybeans grown in the United States. And the old crop stuff is just a reference point of what China typically does. As we move forward, we know that China has zero cargoes or bushels of U.S. soybeans on the books for new crop delivery. And the sluggish Chinese demand story, it's not a positive. And the fact that they haven't bought any new crop beans from the U.S. is not a positive. USDA has this, I'm going to call it crazy projection as of right now, that that export demand next year, the marketing year that begins on September 1st, it's going to increase by 7.3% next year versus this year. And that's given the fact that China hasn't bought a single bushel of new crop beans, and that the book of total sales, which is what really matters, I mean, big picture, is like the worst in 20 years. So USDA, I know you guys always bitch and moan about USDA and, oh, they're too high with the yields. Well, here, this is an instance where they're overstating demand in all likelihood and by a pretty wide margin, which would be to your benefit, if anything, if everybody believes the balance sheets, which they don't because the market sucks.
U.S. farmers are urging lawmakers to keep agricultural products out of a trade war. Farmers are concerned that tensions between the U.S. and China could escalate and impact trade between the two nations. Last month, President Joe Biden imposed tariffs on Chinese goods ranging from EVs to medical equipment. Beijing labeled the tariffs as bullying and said there would be retaliation. Even without a trade war, U.S. farmers have lost a significant portion of the Chinese market as a result of cheaper crops from South America.
So the lobbyists are lobbying, and that's what they do. Adam Schindler is U.S. Grains Council Asia Advisory Team Leader. He said this was in the Reuters piece. This market is irreplaceable for us. There is no market like the China market. So we are here, and we want to make sure our customers know that we will still be here. We want China to know you are important to us. We want you to know that you are appreciated by the U.S. farmer. I mean, this is a really nice effort, but you can't stop the fact that Brazil is growing these monster crops, and that Brazil has just a natural geographic advantage. It's always going to be cheaper to ship beans from Brazil to China than it is from the U.S. So, I mean, you can lobby as much as they want. I don't know that it's the tariffs that are really killing us here. It's just the pricing dynamics and the geography.
USDA reported a flash sale of soybeans on Friday. U.S. exporters sold 4 million bushels of soybeans to China for delivery during the current marketing year. This is the second flash sale of soybeans purchased by China this year, totaling 15 million bushels.
So I said earlier, I'll believe it when I see it. This is a very small amount, not enough to move the needle. Could this be a sign of things to come? Maybe. The market's not acting like it, but we can hope.
The U.S. labor market added significantly more jobs in May than expected. Last month, the economy added 272,000 non-farm payroll jobs, up from 165,000 in April and well over economists' expectations of 180,000. The unemployment rate increased to 4%, up from 3.9% in April and its highest level since January 2022. Wages during May increased 4.1% year over year, slightly higher than the anticipated 3.9%. The market is now pricing in a 53% chance that the Federal Reserve will cut rates in September. Also last week, the JOLTS report showed job openings in April fell to their lowest level since February 2021. There are now 1.2 job openings for every unemployed person.
So the jobs number was good. It was I'm not going to call it a blowout, but 272,000 jobs added. They were looking for 180. If you pull this chart back, it's another chart that COVID ruined. It looks like nothing because of the COVID disaster. 4% unemployment is still historically very, very low. I'm not going to say it's totally bottom of the barrel anymore, but it's pretty damn low. The stuff with the Fed and the bets on rate hikes is almost becoming like comical. It's back and forth every week. We're 50% chance of September. We're 80% chance of September. I don't know. I don't know what the Fed's going to do. It seems to be the thing that the market watches. This is a case where like the all the jobs we added was bad news when it comes to the market because it means, oh, maybe not, now they won't cut. I don't know. I feel like it's almost becoming just kind of a repetitive story that leads us nowhere. What did cattle do on Friday?
They were finally able to find some solid ground. Feeders closed an average of $1.27 higher, but for the week they were $1.75 lower. Live cattle were an average of 20 cents higher on Friday, but for the week they were an average of 133 lower. Cash cattle trade was slow last week. In the South, a few cattle sold at 185, which was $1 lower than the previous week. In the Western Corn Belt, cattle sold at 190, which was steady with the prior week. Box beef was mostly higher last week. Choice closed Friday at 316.75. That was up 3.55 for the week. Select closed Friday at 301.14. That was down 57 cents for the week.
Outside markets on Monday, U.S. dollars up a little bit. Stocks are off. The S&P's off 6. The Dow's down 80. Bonds are down a little bit. Crude oil is up 7 cents in the July WTI at 75.60. Have a great day, guys. We'll talk to you Tuesday.